Hey, welcome to the Airmere Roundtable. Today is the 6th of May, 2020, and I have a special guest, Amy Meissner and Dan Harvey. I've known both of you guys for a long time, and Amy and Dan have both run trade alert services with me before, and Dan showed us this trade a couple weeks ago in Trading Group 1, and well, maybe a month or so ago, and everybody liked it, and Amy thought it was good too, so we're kind of converting it into a service to see if people are interested, but welcome, Dan and Amy. It's great to have you back.
Oh, thanks,
Well,
Tom.
thank you, Tom.
Great to be back.
Okay, so Amy, if you want to take it away, I'll mute myself. I'll be in the background just so there's no background interruptions. So yeah, go
Okay,
for it. Yep.
sounds good. Okay, just wanted to, again, thanks, Tom, for having me here to present this today. And thank you, everyone, for joining. Appreciate you guys being here. And I'm really super excited about sharing this information with you and about this new trade, the Boxcar. First, I guess we have to go through disclaimer. So I've got that up on the screen. Airmere Corporation is not a broker-dealer. Webinars and seminars given by Airmere and Amy Meissner are for educational purposes only. Options involve risks and are not suitable for all investors. Past performance is not indicative of future results, and this is for personal use only. All right, so with that, you want to take a few minutes and or a few moments and just read that over. We will get started. All right, so the Boxcar Trade is what we're going to talk about today. I think you're really going to love this trade. I know Dan, again, presented this, about a couple months ago or over a month ago. I know because he showed it to me shortly after, and I've been trading it for several weeks now. Just a great trade. But before we get totally into this, for people that don't know who I am, my name is Amy Meissner. Began trading stocks and options in the mid-90s and became a full-time trader in 2006. I like to specialize in high probability option strategies. My goal has always been to make a monthly income and consistent returns during a variety of market environments. And I prefer strategies that don't require me to sit in front of my computer all day long. I've done numerous speaking engagements and presentations for lots of different trading clubs and educational trading services such as Airmere, as well as had trade alert services, workshops, and video courses. So that's just a little bit about me. So let's get going on this. One of the things I did want to talk about is that, of course, one of the most sought after attributes when we trade options is we really would love to have quick and easy short-term gains. Of course, it's really great if we can just put on a simple trade and within a few days make our money without having to risk a lot and without having to do much as far as adjusting. The problem with very short-term trades usually is that they tend to have high gamma risk, which means that they, like a slight move in the underlying, can cause a profit to turn into a loss really easily and really quickly. So because of this gamma risk, it's really hard to come up with neutral bias short-term, super short-term strategies. It's not impossible, of course, but it is difficult. So what happens is that a lot of these really short-term strategies tend to rely on some sort of directional bias instead. And if the market doesn't go your way, you're kind of stuck with a lot of adjustments or you just take a loss, that kind of thing. Also, in short-term strategies, we're kind of limited usually from doing too much adjusting to fix things because we just don't have a lot of time. So adjustments tend to make things even more directional. And so basically, you better be right kind of thing. So in order to fix those issues, we tend to create longer term option strategies, especially if we're looking for income generation on a regular basis. And longer term strategies tend to allow us to be a little more neutral on the market direction. We often start off with a really flat T+0 line. It gives us lots of room to the upside or the downside. And since we're in the market longer, we make sure that we have a good risk management adjustment plan just to make sure we stay safe while things are, moving along and while we're waiting for profits to come in. Of course, there's a lot of great strategies out there that do just that. Both Dan and I have created quite a few, but of course they take a little longer to see the profits come in. They don't have to be super long, but generally we're talking about 30 days to hit the target profits, and many of those strategies actually can be a lot longer. So in addition to that, they also tend to have a higher margin requirement. And of course, that margin is being tied up during that longer period of time. So what would happen if we tried to merge the pros of a longer term neutral strategy where you don't need to pick direction, you got a flat T plus 0 line, you got lots of room for the market to go up or down, but you have those really short-term profit potentials. Well, that's what the boxcar strategy is all about. The boxcar strategy is a short-term neutral strategy with a high win rate and the ability to make quick and steady profits while keeping any drawdowns really small. The initial setup of the trade is created precisely to allow the underlying a lot of wiggle room to the upside or downside without a lot of risk. And you can see here in this graph, you've got, these T lines set up, the T plus 0 line here, which starts off, it's very, very flat T plus 0 line. And then because it's a very short duration trade, these T lines are actually very, very short duration. The red is T plus 2, so that's only 2 days in the future, then T plus 4, then T plus 6. So this is a very short time. And as you can see, you've got a lot of profit potential in that very, very short time. Even just in a couple of days, you see this T plus 2 line really widens out and is also continues to be very flat, which allows the underlying to move quite a bit without getting the trade in trouble, even if, without having to do any adjustments. In addition, you can see this this gray area represents the standard deviation, and we try to keep these. This trade is try to keep it as much away from at least one standard deviation as possible. Not all trades are perfect, but as you can see, it gives a pretty good range for the underlying to make money. It has the advantage, of course, not just of bringing in that theta quickly, but the average is actually, pretty good profits. The average is actually 7% or higher per trade of profits without taking all that excessive risk. Of course, the boxcar was recently developed by Dan Harvey. So thanks, Dan, for being here. I appreciate it. And he was nice enough to share his methodologies and techniques of this with me. And as you may know, Dan and I have worked together on a variety of option strategies over the years, as well as trade alerts and workshops like the weekly playbook that we did not long ago. And now that he's fully retired, he's passed the teaching baton of this particular strategy on to me so that I can share it as a trade alert service, which is one of the things we'll talk about today. So, and Dan, you can, pipe in whenever you want. I appreciate you being here as well. I know you can't stay that long, but I really appreciate you showing me the ins and outs of this new strategy, and I'm really excited about it.
Well, thank you, Amy. That was a very gentle way of saying that. Yeah, I like the passing the baton metaphor. And yeah, I just would add, Amy and I, as she said, we've been friends a long time, and she is an excellent trader, and she showed a lot of interest in this. So I thought this might be something that she would perhaps want to begin a service with. And so that's the way that this all started. Amy will be running everything, but she and I correspond a lot. She'll be taking any questions that anybody would have, but I'm sort of running in the background, so to speak. And so go ahead, Amy, take it away, and I'll be signing out or signing off in maybe 15, 20 minutes or something. But if anybody, had any specific questions to me before I leave in about 15 minutes, you can either ask them or post them in the chat, whatever.
Yep. And yeah, thanks, Dan. I appreciate it. I don't know if any of you know, but not just have we worked together for a long time. I've known Dan since I pretty much started trading options full time, and I consider you to really be my true first mentor in getting started in this crazy business. So I appreciate all of your insights over the years. And
you bet. There was a question from Steve that you may want to address right away, Amy, to avoid any confusion.
Let's see here. Stupid question, but do you mean by running it as a service? Yes, this is going to be a trade alert service new trade alert service, and I'm going to go over all the details of what you're going to get towards the end of the presentation. But it's going to be just like a usual, like we used to do or like Dan used to do the road trip, and I used to have the weird where we're sending out trade alert messages. And in this particular case, since we're having multiple opportunities per week, there's going to be lots of opportunities to trade. So it'd be just like a true trade alert service where you're getting all the trade setups, any adjustments, closings, all that kind of information to follow along with me in trading this. All right. Okay, so what exactly are the characteristics and benefits of this wonderful trade? So first off, it's a very short-term trade. So it's designed to make quick profits. As I mentioned, a lot of strategies are 30, 60, 90 days or more. And the longer term they are, the longer amount of time before any profits begin to appear. The short time period of the boxcar allows you to make those profits really quickly, but it's still very nimble if the underlying goes up and down, as I kind of showed you real quick here with these, this wide and very flat T+0 line, which you don't normally see in a very short-term strategy. And I'm going to go through tons of examples of this as well. So, keep that in mind. It's also market neutral. So with the boxcar, there's no need to guess direction or set the trade up to deal with any particular direction that you might think is going to happen. Of course, we all want to be right when we guess direction, but none of us has a crystal ball. I wish we did. And of course, even for those who are really good at accurately guessing market direction, the timing can make all the difference. So the boxcar is set up as a neutral strategy, which is set up to be resilient, whether it goes up, down, or sideways, or choppy, and so forth. It also has a very high probability of wins, which is great. As I showed you, try to keep things as high probability as probable as possible, keeping things wide and, at least one standard deviation in a short amount of time so that we have room for the market to go up and down. And this helps keep the strategy having much more winners than losers. In addition, one of the really great features is it's a low Vega trade. It has a very low sensitivity to volatility. As you know, which can be one of the main risks in options income trading. Most income option trade strategies, the Vega can have a really big effect on the profit and loss of the position. But because the short-term expiration cycles for the boxcar, which are 14 days or less, it's not very sensitive to moves in volatility at all. And this is actually an added benefit, which you're going to see when I show you some of the examples. But that added benefit is it allows you to rely a lot more on your future T+0 lines. So when you look at something like this graph and you see these T+0 lines, as you know, if it's a longer term trade, they tend to kind of change depending on what's going on with volatility and so forth. They're not quite as accurate. So you have to kind of have a good feeling or a good guesswork of trading that underlying for a long time to kind of have a better feeling for how realistic these T+0 lines are. However, with the boxcar, they're very accurate. So it just allows for a much clearer picture of your position overall, which is great. In addition, it has a very low gamma risk, which I mentioned before, which is very unusual for super short-term expiration cycles. A lot of those super short-term trades, or once you get down to close to expiration, they tend to have a lot of gamma risk, which of course can make the profit and loss move quite a bit, even with just a small move in the underlying. But with the boxcar, the gamma risk is very small. As a matter of fact, it's so small, it's able, again, to create these very flat and very accurate T+0 and T+ future lines. It also has a really good return potential, I think. Of course, it's always great to have strategies with high returns, but, and not just high returns, but quick returns. So the boxcar is designed with the ability to create those high returns on a consistent basis. It's got that high probability, high win rate aspect of it without having excessive risk. And with such a short-term trade duration, there's also the opportunity to have general to generally have multiple opportunities per week, not necessarily in the same underlying, but because we're doing this in stocks, or you can do it in ETFs or indexes and so forth, you have you could put on multiple opportunities per week, and then of course every week you could put on opportunities. So that also allows you to increase your potential return over the long term, instead of just doing like one trade per month, tying up all your margin, right? And in addition to this, these, of course, profits are pretty decent profits. So the average that I'm seeing is, I like to average around 7%. For me, just because I want to take my profits as quickly as possible, I don't want to do a lot of adjusting. I like to target a quick 5 to 7% with higher potential of 10% or higher, easily doable. And I've had quite a few trades like that as well. And I know Dan will even stay in a little bit longer, which is something, of course, is easy to do, and even create higher profits of even 20% or more. You want to
Well, that's right, Amy. And one of the things, as I'm sure you'll discuss, is when the trade is nearing expiration and the market is sitting under the wing, which is what I call, and what I guess Amy calls, the broad area of the boxcar expiration curve. When you're sitting under the wing, and every day it's cha-ching, cha-ching.
Yeah.
And so if you're fortunate enough, and this is not an infrequent event, but if you're fortunate enough to be working the trade, sitting under the wing with just a few days to go, you're on the gravy train. And I've had several that have returned more than 20%.
Yeah, yeah. And I like I said, I like to take just the quick profits and get out and get my risk off. But there's nothing wrong with staying in, and you can do some additional adjustments if needed to keep this thing, like Dan said, just chugging along and keep making money. That profit comes in real quickly. And I've got some great examples of trades where other systems you might want to just say, oh, I'm out. I don't want to be in this position, but because of these really accurate T-lines, future lines, you can see that just by staying in, even if it continues on that move that you think might be bad, it actually can bring in, just a day later, bring you into a really nice profit, even if it continues on that way. So it's pretty robust in that respect. Really one of the things that I love about it. Of course, another thing that's really important is it has low drawdowns. Of course, we don't like to lose money when we trade, but we do have losing trades. It does happen. It's not every single trade is a winner. But so the most important thing we can do is manage the risk and keep the size of any losses as small as possible. With this, really smooth T+0 line, we have the ability to allow the underlying, again, I'll go back here, to really move around, giving us plenty of time to make any adjustments if they're needed. And if we do have some bigger moves, it really doesn't hurt the position all that much. You'll find that it's really, pretty easy, even when the underlying is moving around quite a bit, to keep those losses pretty small. Of course, there might be an outlying event where we have a big, big move, more than one standard deviation. But if it happens, after you've been in the trade for a couple of days, you still might be in a pretty good position. So and you're not really taking on excessive risk. So we're not doing anything like 10-to-1 risk to reward ratio. So it's not something that's set up to blow up an account or anything like that, regardless of how the market moves. But in general, even with some really big moves, you're talking about some very small, low drawdowns that I've seen. So
let me just answer a couple of questions here from Steve. Hi, Steve. Well, I calculate the return based on margin requirement. Amy may do it a little differently. This is going to be Amy's service, so she'll differ from me a little bit. But anyway, that's the way that I calculate it. And the potential drawdown, I have not, the maximum drawdown, of course, would be on the left side there if the stock or the underlying suddenly went to zero. clearly that would not be good. But I've not experienced anything like that. In fact, a lot of my risk has been on the upside, the stock moving up, and I've had to make some adjustments to the debit spread, which Amy will discuss. But because the gammas are so low, I've always had lots of time to react if the stock begins to move down. And as far as the win-loss ratio, mine is up around 75% winners. But that also depends on your management of the trade. If you, like any other trade that generates positive expectancy, if you take your profits early, you'll have a super high win rate, but your average win will be lower. So some of this is a matter of personal choice. Setting up stop losses, you can do that on the downside. Yes, I don't do that on the upside. You can do it on the downside. So that's all, Amy. Sorry, I just
Oh,
wanted to
no,
go ahead and get those
I
questions
appreciate it.
answered here.
Yeah, just and I just reiterate, answer Marcos. You asked what instruments are traded. This can be traded in stocks, ETFs, the SPX for the service. I'm going to be doing a variety of different stocks. It just depends on which are good candidates for that particular day that I'm searching. And I like right now the SPX has pretty good volatility. So the SPX is a pretty good instrument as well.
Yeah, I've had my best results on the SPX. Probably you too, Amy.
Right now, yeah, as far as dollar amounts, yeah. But I have been having some great results with some of the stocks as well. So
I've had good results also, particularly with Amazon.
Mm-hmm.
And I know that, some people might be saying, oh my God, you can't trade Amazon, but you see, you can because of the debit spread.
Yeah.
You're not really limited. So I trade Amazon and Tesla and Apple and no prob.
Yeah.
And so Amy will discuss the selection of candidates to some degree, and then when she starts the service, I'm sure you'll discuss in great detail, right, Amy?
I'll have a lot more information when we, for subscribers, obviously, we're going to have a kickoff meeting and stuff. So I'll talk about that in a little bit. But
and no restrictions on IRA accounts, Marcus, because these are all spreads.
Yeah, there's no naked. And just real quick, Steve, when you asked about how is it calculated, I calculate them on Reg T margin, so the actual margin that's used. So same thing, maximum amount of margin is where the percentage is calculated. Andrew's asking about how reliable are those two T+2, 4, and 6 projections. They're extremely reliable. I've noticed that, and I'll show you when I go through some of the examples how reliable they are.
These are amazingly accurate. And the other thing is if you don't happen to have software like OptionView or OptionNet Explorer, which I don't. I have those anymore. I track mine on a spreadsheet that I'm able to calculate my realized gain or loss, and then I can very quickly compare this against what Thinkorswim is showing, because it shows only open positions, and I know at a glance where I stand on the trade. So that's really easy. And sometimes I'm faced with the very pleasant decision of saying, do I want to take $800 or do I want to go for $1,000? And of course, that we're all traders here, so that's a matter
the nice
of
thing about these lines being so accurate is that you can make a really educated decision about doing that. Like, how realistic is it? Whereas a lot of trades, you look at the T+ future lines and you might ask yourself the same question, risk versus reward, but you might not rely on those T+ lines as much because they can be affected a lot by Vega or Gamma and so forth. In this particular strategy, these T+ airlines are really accurate. Actually, sometimes they're better than what they show. So, sorry, I didn't mean to interrupt, Dan.
Well, that's okay. And Marcus, Thinkorswim, I guess you heard me mention, that's a trading platform that's used by many traders, option traders in particular.
Mhm.
And that's what I was referring to. So I have obviously my trades set up on Thinkorswim. I'm sure Amy does as well. And since I don't use a third-party software to analyze the options, I just use my spreadsheet. But I can see my realized gains and losses on the spreadsheet for each individual trade, and then I look at the P&L, profit and loss, that Thinkorswim is showing me real time, and I know at a glance where I stand on the trade, and then make my decisions accordingly.
Yeah. And you can actually use Thinkorswim's analysis tab to kind of recreate what you see in Option View or Option Net Explorer as well. There's
Right.
ways to do that.
Yep.
I know there's a lot of questions coming through, so I think what I'm going to do is just kind of go through some more of the presentation, then I'll just go back and kind of answer from where we left off, if you guys don't mind, just so I can kind of keep things moving along.
Well, right, Amy, and I think this is a good place here for me to sign off, and you're doing a great job here. I've reviewed your PowerPoint, and I know that you're an excellent trader. And for people who are interested, and I hope there are people, I love this trade myself. Of course, naturally, I have bias. By the way, I called this the boxcar because, you know, like most people, like most guys, when I was a kid, I liked trains, and the nearly vertical walls of this thing reminded me of the profile of a boxcar of a train. So what the heck? That's what I called it.
I like it.
Yeah. Well, thanks for stopping by, Dan.
Yeah. And Dan, I don't want to put you on the spot too much, but hopefully when we launch this and we do our live kickoff meeting for those that sign up for the live, in time to do that live kickoff meeting, where we're going to go through obviously more details of the service and of how to use the service, and also what to expect as far as all the trades, a little more, obviously a lot more detail about it. Hopefully, Dan, you can join us as a guest on that kickoff meeting as well. We'd love to have you.
Well, yeah, I will be there, and we'll just have to schedule it, together.
Yep.
But I will be there, and then now just before I leave, I'll answer Steve's question, because I think that's probably directed to me, since it's referencing a spreadsheet. Yes, it is possible to do RTD links to a spreadsheet, and of course I've done that in the past. I'm not currently doing that because the way I devised my personal spreadsheet, I just do copy and paste, and at the end of the day, or even intraday, and it's just very simple to drop the trades in. So that's the way I do it. So anyway, thanks a lot, Amy. Thank you, Tom. And I hope everybody enjoys the rest of Amy's presentation here.
Thanks, Dan. I appreciate it.
Yep. Thanks, Dan.
I'll talk to you soon. Okay, so where were we here? Okay, we talked about obviously having a nice growth equity curve, which I'll show you in a bit. It's also very simple. It's got simple setups and a very simple adjustments, if any adjustments are needed. Great strategies don't need to be complicated to be profitable. So that's why this one's set up. And I know Dan thinks kind of the same way I do, which is why he's always been one of my great mentors. Is he likes to do things very simply. Simple setups, me too. And we don't like to do a lot of fussing around, because we don't want to sit in front of our computers all day long. So we both think alike in that way. And so that's why the boxcar was set up to easily execute, keeping any adjustments, if any are needed, as few as possible, and very simple and simple to execute. So basically, if you know how to enter a spread order, then you can pretty much understand everything you need to trade this particular strategy. Can be traded in stocks and indexes. So I'm going to be obviously looking at, stocks that have, good volume, and the options that are traded within it have good volume and open interest and are traded, and they're very liquid and so forth. So I'm going to be doing all of that work for you in the service, but it can be traded on, different stocks and indices. Every week, there might be different ones that are good candidates than other weeks. Sometimes there'll be multiple weeks where you get the same ones over and over again, and then all of a sudden a new one kind of pops in. So I'll be doing all of that work. Of course, again, there's going to be multiple opportunities each week, so it's a great income generator, especially since it's a high probability trade. So you can have multiple trades on under multiple underlines, including the SPX every week. Great for small accounts. Boxcar suitable. Most trades are requiring under $2,500 for Reg T margin, as far as what I'm going to do in the service. But most trades are under 2,500 of Reg T margin. The SPX usually under $5,000 per trade for the SPX, but it's also, it can be lower as well. It's easily scalable because it's being traded in liquid stocks and indices. It's easy to scale. So, and the trades that I'm going to be sending out are easy to scale. You just, add a multiplier if you have a bigger account. And of course, it doesn't require you to sit in front of a computer all day, which is one of the things that I require for the strategies that I like to trade. It's, I live here in Southern California. It's beautiful most of the year. I want to get out and do things. I don't want to be stuck sitting in front of my computer. And of course, there's a lot of you that might have full-time jobs, or you're retired, you're on vacation, you have other hobbies. You might have, you want something reliable, but you don't want to be sitting in front of a computer. You only have a limited amount of time to deal with this. So this trade does not require a lot of your time at all. Okay. A little bit more information about it. The contract cycles that I'm going to be using are 14 days or less to expiration. So again, really short term. Planned capital. Most of the stock trades in the service are going to be averaging under $2,500 for a Reg T margin per trade. And again, the trades are not on for very long, less usually, a couple days, 5 days. I think it's 5 days on average, something like that. You can stay in longer, like Dan had mentioned earlier, if you want to really, if you're underneath that wing and you want to, really get some exponentially higher profit potential. But I'm going to be sticking with a more conservative approach, at least in the service, where I'm getting out as soon as possible. So my days in the trade are going to be probably a little bit less, but even with staying in longer, it's pretty short term. The SPX trades are going to be kept under $5,000 of Reg T margin for the service. Again, everything's scalable. Minimum account size, I would add on, a few $100s. So I'm just going to say, about $3,000 for those who might only want to trade one stock candidate per week. The class account that I'm going to be showing the progress of is going to be set at $12,500. That way I can handle in the class all of the trade setups that I'm sending out. And you can kind of follow along with me and see how that is performing. The profit target, I look for really quick profits. So I'm looking for 5 to 10% profits, which usually come pretty quickly. If it's going to make a profit, it's going to come in pretty quick. And of course, losses should be kept small, generally kept under the average profit, which I will show you some of the statistics of what I've actually found with the trades for this particular strategy. So this is a strategy, as I mentioned, Dan Harvey came up with not that long ago, actually, but he's been trading for many, many years, and so have I. And a lot of the strategies that both of us come up with, we've been trading for years that are, highly profitable. And so we have a pretty good feeling for if something's going to be viable or not. And this trade is, definitely showing, exactly what it can do. And it's, like I said, very, very simple. So he began trading this, I think, early March. He did a presentation on the roundtable talking about it. And then a couple days later, we were on the phone and we were talking about it, and he was showing me what he was doing. And I started trading it. And so these are results over the last several weeks. So basically mid-March through the end of April. And I'm got a couple trades on now as well. And as you can see here, this is just what, maximum amount of capital used at any one time was no more than $12,000. So just a $12,000 account. And over that 6 or 7 week period, I did 19 trades. The total profit was $4,270 on a $12,000 account. That's pretty good. The win-loss ratio is more than 5 to 1. Out of those 19 trades, there were 16 winners and 3 losers. The average winner was $281. The average loser was $80. The largest winner was $585. I believe that was for me on an SPX trade. I know Dan likes to keep them a little longer, and you know, I'm sure a lot of his come in, you know, maybe even double that. The largest losing trade was 162. The average days in the trade are, you know, in my case, about 3. Some of these were, you know, put on with only 10 or 8, 9 or 8 days to go to expiration, but they're definitely kept 14 days or to expiration or lower. The maximum consecutive winners were 8, and the maximum consecutive losers were 2. So you can see it's got a, you know, nice growth curve here. You got some, you know, obviously there's some losers and stuff, but not a big, nothing big as far as big dips down. You're not, you know, having to make up for big losses. So as you can see, it really creates a nice, pretty smooth graph that goes obviously in the direction that we want it to go from, you know, higher and higher numbers here. So it's a pretty big percentage wins on a very small account of $12,000, you know, $4,200. And this included commissions as well for a very short period of time. So let me just take a quick peek at the questions, and then I'm going to show some examples, and then I'll get back to questions again. So I'm going to try to answer everybody's questions. See, so you've got the spreadsheet question. This setup is very simple. Why do you need a service? There's a lot of things going on with the setup. It's not the type of setup where you say, okay, we're always picking a delta, you know, buy or sell a delta of this and buy a delta of that or whatever. It doesn't work that way. First, there has to be a search for which are good candidates for that particular day. So every day I look for candidates, you know, what stocks would be a good candidate in this particular moment in time. It's not always going to be the same. There might be some stocks that just typically end up being good candidates quite a bit because of the type of volatility, the types of moves that they have. But then there's new ones that kind of pop up all the time. So picking the right candidates is part of the service as well. In addition, like I said, it's not the kind of setup, it's a simple setup, but it's not picking the exact strikes. Changes, even changes depending on, it could be the same underlying and it might be different this time than the week before. And that's just because of the precise mathematics of the trade in order to get the best, you know, not so much that we're looking for the best Greeks, that we're looking for the best mathematics to set the trade up to give us the most room to the upside, the downside, the best, you know, set up so that we can bring in theta quickly without getting into trouble quickly, that kind of thing. So actually, I have a perfect example of that is when I was first shown this trade by Dan, and I started going back and I even put some back tests in, and then I started putting in some live trades in. I was building them based just on Greeks, and I had pretty good results. But then we had some more conversations, started narrowing down a little bit more about, you know, why wasn't I seeing, you know, this, the type of results that I should have been seeing. I was seeing like, you know, 4 or 5% profits, not 7 to 10% profits, and unless I stayed in longer. And so we went through, you know, a little more detail of everything, and I realized, okay, I'm not doing the math right. So going back and changing some of the strikes and then going forward with live trades with this new method of entering the trades, that's where these particular profits came in that I'm showing you these particular results. So this is almost double of what I was able to do before. So it really makes a big difference of not just picking the right candidates, but also picking the right strikes at that particular moment in time to set the trade up to be able to make the most out of it as possible. These results are not simulated. These are real results. And yes, they did consider commissions and slippage. Yes, I'm going to show Steve examples of different things where the market moved up or down, or that particular stock moved up or down or sideways. I got a whole bunch of examples I'm going to show right after I get through a couple more of these questions. The max drawdown during the period, I believe, was about, you know, the max loss was 162. I don't think there were any more drawdowns than maybe $250 on any one trade. And most of the time they go into profit pretty quickly and they stay there. I don't know what 22% is there. How do you handle the risk of assignment with stock? I don't stay in until expiration. You are going to have a possibility of one or two of the strikes being in the money. Of course, it's based on it's part of a spread. So the best thing you can do there is just not stay in until expiration, which I do not do. I usually close it out with at least a few days or more to go. Okay, so I'm going to talk a little bit more about some of those questions. Let's go through some examples. I think you guys are probably ready for some examples here. So, example trades. Here's a couple of typical trades where no adjustments are needed, and this is pretty typical. You don't always need an adjustment on these trades. So, example 1 and 2 are just a typical trade where no adjustments are needed. Here's the beginning of this particular trade. Again, you can see it's high probability. We're outside of one standard deviation. We got these nice flat T plus 0. This particular case, this is T plus 5 and T plus 10 in this particular case. This trade was probably more of a 14-day to expiration trade. Let's go here. The end of the day, of the very first day of entering that trade, we're already showing a bit of a profit. 3 days in the trade. This one, just didn't move around a lot. Happened to be under the wing here, but even if we were outside of it, still had a lot of profit potential. It's already up 10.9%. So this is one where, again, you can really rely on these T lines. You could try to, maybe move up this side of the 10 if you want. There's lots of things you can do, but in my case, I want to keep this as simple as possible. I just made 10.9% in 3 days. I'm done. So I'm out of there. Example number 2, similar situation, different stock, nice flat T plus 0 line. Wasn't quite able to get out to exactly one standard deviation here, but we got lots of room. The next day we moved down. I had a pretty, decent regular down day or whatever for that particular stock. It was a pretty big move. Obviously there's going to be higher volatility stocks, but we're up. So again, you look at the T plus 0 line here, and if we moved over here, you'd probably be flat or maybe a tiny little loss, right? But because these get theta so quickly, we've got this high theta, Vega is really low and it doesn't really affect much. Delta is very flat and the gamma is just, super flat. So it doesn't really affect much either. So that allows just 1 day in the trade, the market might move down and all of a sudden you've got a lot of that theta captured in it and theta just keeps moving up. 2 days in the trade, it's already up 9.1%. Again, you can take a quick profit if you feel like staying in. These T plus future lines are pretty accurate. So unless you have a feeling that that underlying is going to move one way or another, a really big move, and even if it does, this thing can make a pretty big move to the downside and still make more money in a couple days than where it's at now. So usually the upside is the one that you have to deal with a lot more. All right, so those were just a couple of examples where you didn't have to make any adjustments, nothing much going on with the underlying. It did move around a little bit, but nothing too much. So now in examples 3 and 4, I want to show you what would happen if the market or the underlying moved up enough to where you needed an upside adjustment. So example 3 here, again, start off nice and flat. You got room to the upside and the downside. And look at our Greeks, if you want to look at the Greeks here. Again, these are not what I'm using to figure this out. I'm using mathematics of the strikes to figure out where I need to put things. But it keeps, just the Greeks will end up working out appropriately. Again, outside of one standard deviation. Moving forward, 2 days in the trade, I don't really have a lot of room to the upside anymore. I'm not in trouble, the trade's still up, but I can make more than 2.8%. Let me make an adjustment. So make an adjustment. That brings my right side of the graph up above the 0 line. So now I can't lose any money going up. So I've got money I could make going up. And I still have room to the downside. My tent is way out here. And these, even though I got lots of room with a T+0, but the next day, I'm going to have even more room. So this is a T+2 and T+4. That just is expanded out even more. So if I continue going up, okay, I can't really lose any money, no big deal. But if I can come back into the tent in a couple of days, I can make some pretty good money. So 5 days in the trade, we pulled back a little bit, up 4.5%. So, feel pretty good about this. I can stay in longer. 6 days in the trade, we have a continued pullback, but I'm still up. So we had a pretty big pullback there, but I'm still up about the same as I was the day before, right? And I know these T+0 lines or T+ lines are really accurate. Now I've got T+1 and T+2. So in one day, I've got a lot of room for this to move either to the upside or the downside. And in this particular case, it decided to move up a little bit, and now I'm up 10.2% in 7 days. So that's a pretty good spot to close the trade. All right, another upside adjustment trade. Here we go, started the trade, nice and flat. 1 day in the trade. I've actually got two versions of this trade. So in this particular case, this was a Friday. So even though I'm okay, I might say, well, I might want to prepare for the weekend, and doing an upside adjustment might be a good idea. So I can do that and flatten everything out, and then, see what happens over the weekend. In this particular case, we had a huge move up the following Monday morning, or the following Monday. But because of that adjustment, I was able to still keep a nice profit there. But let's say I didn't do that. Let's go version 2. Let's say 1 day in the trade, it's Friday, but I don't adjust over the weekend. I figure, it might pull back, or I'm willing to take the risk. It doesn't really move that much or whatever. We wake up Monday, and it does have a big move on Monday. So it does need, this is Monday morning, it needs an adjustment for sure. So I make an adjustment. It doesn't help the right side of the graph as much as if I made it earlier, but flattens everything out. And now I have the opportunity that if it does decide to move back, I can, maybe make a nice profit if it goes into the tent. But if it continues to go up, I can decide to just take it off, or, break even, or a very small loss, that kind of thing. So again, keeping any losses that might happen as low as possible. In this particular case, the next day it happens to have a big down move, which allows the trade to be profitable again. And so now again, I can just keep it on, or I can take it off. I know that if it continues to go down, I'm going to have a nice profit potential over here. But if it goes up, I might give this profit back, but I'm not setting myself up to lose a lot of money. All right, here's another example that happens a lot with stocks, especially. We have this big gap up, something happens, some news or whatever, and you get a big gap up. So in this particular case, I think this was Zoom. I started the trade, everything looked good. Next, day, had this huge move up, monster move up. 10 points. That's a lot for, that's not 10%, but it's close. It was a pretty big move up for this stock, and it kept going up. And so in this particular case, it went up so fast that there really wasn't anything I could do as far as adjusting the trade, or I felt like, didn't want to add more risk, that kind of thing. So, or don't want to mess with it. I'm only down $50, 2.7%, down $50. No big deal. Yeah, I'm going to have a little slippage. I'll have a little commissions, but it's, going to be certainly under $100 loss. So again, drawdowns are kept pretty small there. All right, what if it's choppy and you back and forth and you have to do an adjustment to the upside, then you have to do an adjustment to the downside or whatever? Doesn't that take away from the trade? So this is an example of that. Let's see what really happens here. So we start the trade. We have a big move down. And even though we had that big move down, we're only down $33, 1.8%. It's not, hurting very much. But I do want to, protect myself in case we have another big move down. Even though if you see this is T+3 here, this red line, it still gives me in a few days quite a bit more room to the downside, but maybe not tomorrow, right? So I do an adjustment, kind of flatten everything out, very simple. And I definitely have faith in these T plus lines. That's 1 day in the trade. 2 days in the trade, the stock moves back up, and actually the T plus line looks even better than what it showed. So now it moves back up, and I already made an adjustment to the downside. Now I got to make an adjustment to the upside, but it's not hurting my trade. It still has lots of ability to make profit. So in this particular case, one thing you can do is add premium, but that does add margin. So just add a little bit of margin, flatten everything out. Really liking these. This is T plus 3 here, T plus 6. 4 days in the trade, we kind of stuck in that area, and we're up 11.4%. So even that chopping around, having to kind of maybe reverse a previous adjustment doesn't really hurt the trade. All right, this is my last example of a large move down. We just had this happen last week. We had pretty big move down in the market and a lot of stocks as well. This one is actually the SPX. So I started the trade here, and the very next day we had a pretty big gap down. I think we were down 50 points in the morning, and then down like 80 points by the end of the day. So I had a pretty big gap down, and I'm only down 88 bucks. Not too bad, 2.7%. So I want to make an adjustment, kind of flatten things out. The end of that same day, it continued to go down another 30 points. So now we're down, I think, 80 points on the day for the SPX, pretty big move. But we're only down 85 bucks. So and I have room. So I feel confident about these T lines. So I know that even if I, open back up down, and this is a Friday, so even if I open down on Monday, it still has some wiggle room to the downside and certainly has room to the upside. So again, this could be just, okay, I'm just going to take a loss, or I'm going to stick with it. So we opened down the following Monday morning, but here's where I wanted to show how accurate these lines are. So this is Friday, so Monday morning is actually T plus 3. So this line is T plus 2. So T plus 3 is going to be out here a little bit more, but if you can see here that a little above 2,800, we're at a break even 2 days from now, which is Sunday. So really we have an extra day of theta, which we have some pretty good theta. So really, if this moves down even 30 points or so, it should still be around break even. And that's pretty much exactly what happened on Monday morning. We moved down to 2804, which I think was like 26 points down, which is a pretty 1% move down. And we were basically break even. So that really shows how accurate those future T lines are. And then, again, well, I'm really close to the left side of my tent. Maybe I should just take this thing off, which is would have been a good idea. But I like to kind of, let things sit for a bit. Sometimes, like the first thing in the morning, obviously, I want to see what's going on. If it's going to continue to go down, are we going to have a little relief rally, that kind of thing. And of course, this down move faded, and it just kept fading and fading and fading. So I kept waiting and waiting and waiting. I had, wasn't sitting there staring at my computer. I was out doing things. I can look on my phone. It's very easy to trade this from my phone as well. And in this particular case, that move just completely faded. We ended up positive at the end of the day, and I was, up 9.6%. I just took off the trade and made a nice profit. So I'm going to answer all your questions in a bit, but I just want to tell you, obviously, I really love this trade. I think it's a great trade. Dan and I thought this is a great idea, and I talked to Tom. Let's create a trade alert service from this. Dan doesn't really want to do any teaching or answering questions anymore. He doesn't mind talking to me about stuff if I have a question. But I've done multiple other trade alert services here with Tom at Aramir before, and we thought it'd be a good idea to offer this one as well. So what are you going to get? Multiple trades each week. So there's going to be multiple trade opportunities. You can take which ones you want and leave others on the side. It doesn't matter. They're going to be sent out as real-time alerts via email and or SMS, depending on what your text messages, depending on what your preferences are. And those alerts will be sent out for opening, adjusting, and closing trades, just like all the other trade alert services here on Aramir. I'm going to have a kickoff video with the guidelines and also how to use the service. And so that way you know what to expect as you're getting these real-time alerts to trade this strategy. And that is going to be a live kickoff meeting. So anybody who signs up before the start date, obviously you can join us live, so you can ask more questions and so forth. So that's a benefit. There's going to, and of course it'll be recorded, so if you can't be there live, you can watch the recording or rewatch it. Weekly video recaps. I'll be going over trades every week in these weekly video recaps. And of course, as a subscriber, you're going to have everything, all access to everything on the class page, as long as you maintain your subscription, which includes all the videos, like the weekly video recaps, kickoff video, any other videos I might do, trade messages, and trade history, the actual performance of the class account kind of thing, and what's happened. And so what we're doing is, normally it's going to be $129 a month, but obviously this is a new service, so we're doing a special where it's going to be only $99 a month. So if you sign up during the special, it's 99 bucks a month, and you keep that 99 bucks a month throughout your subscription as long as you stay subscribed. And the first month is 50% off. So the first month is only like $49.50, so pretty small amount, especially considering what a lot of these trades produce. So I think you guys will be really happy with this. I know there's a lot of people that did like the weekly playbook trades, that they like those weekly trades. So this is a really great way to have some very nice weekly income potential, and with multiple chances to take trades throughout the week. So in order to sign up, you can go to aramir.com/boxcar. The introductory pricing is going to be good until May 15th. So I think it's like 8 or 9 days from now. Again, 99 bucks a month for as long as you're subscribed, but the first month is 50% off, only $49.50. And I think if I go to that page, at the bottom is a little button here to pay for the service. So I can copy that link and just put it directly into the chat box, and then I'm going to start answering questions. So here's the link. Sign up directly. You can just go direct there. Okay, so let me go back and start answering questions.
I had one too.
For sure.
Did you look at this trade during the big drawdown, say in February?
No, I didn't. I was having problems with trying to do a lot of back testing because it's really tough, especially with stocks, even though they're very liquid, to get I was able to go back, and I had pretty good results as far as if you missed the day that everything went crazy, or a really, really crazy day, then you didn't have a problem. If you had a whole bunch of trades on, the day before everything kind of went crazy, then what would end up happening? If you went from before everything went, let's go back. You know what? Let's go here, charts. So if you came in here where you're like kind of at a high, and then all of a sudden you have these big gap down kind of thing, then you ended up outside of that one standard deviation. But if you look at the graphs, here's my presentation. Oops, here we go. If you look at the graphs, oops, that's not the one I want. Why am I not finding? Here it is. So, for example, let's go to the start of a trade here. You're not really putting on a lot of risk per trade anyway. And the T plus lines they're not gonna go straight to zero. It's not like you're going straight to expiration day. So you're probably, most of those would have ended up to be, a decent loss, but easily made up. The problem with trying to back test then is I just didn't feel confident enough on any slippage. Like, are those really prices that I would have gotten? So I felt more confident going forward and trading with live data every day, which is what the results that I gave are. But that would be a good educational thing that we can go back and kind of, have a video where we back test together, like, well, what if? But, we're not setting up these trades to be like 10-to-1 risk reward ratio. Maybe a 2-to-1 risk reward ratio, or 1.5, to 1 risk reward ratio. So, even if you just closed your eyes and let it go to 0, and waited until expiration day, instead not take it off during one of these on one of these T plus lines, then that would be the only time that something like that could happen. And again, you're not setting it up so you're everything's an all in or nothing where you can blow up an account. You don't want to use this in a way where you're going to blow up your whole account if one stock has a really bad situation and you decide to let it to go to expiration. It would be tough to do that. But let me answer does that answer your question, Tom? Or?
Yeah, I was just curious, that's like the worst case scenario for most strategies.
Yeah, so, and that's something that, let's take a look. What was that, Google? So like that would have been like February 21st to February 24th. So if we went over to Google, and I don't know what it's, it might not have been a good candidate at the time, I don't know, but Google's usually a pretty good candidate. And let's say I put on a trade, if I put on a trade here, just going to put on a debit spread there. Let's just see where one standard deviation would have been 1301. And, so I'm probably going to put something on, somewhere around this area, trying to be outside of one standard deviation. So somewhere around 1300, maybe put some risk on between there and 1275 or something, depending on what I could get at the particular moment in time. So let's just see where we ended up that next day. Wait a minute, that's not.
That was today, I think,
That's
right?
today, right. Where's 420 or 3? Oh, that was today, duh. Sorry, guys. Forgot to change the calendar. Like, something's not right here. So let's say the 20, so on Friday, let's say. Okay, so one standard deviation here is, sometimes I have to put something in just to see what it would be. Just put anything in at all. Okay, one standard deviation is about 1440. So, I'm going to put something on somewhere in here, somewhere between, maybe 1400 and 1440, something like that, for where my risk is to the downside. But I'm going to hedge it to the, on the upside too. But just to see where we ended up, we dropped that next Monday to 1427. So we would have dropped outside of that box. So theoretically, and I'm, this doesn't have a lot of volume going on. It might not have been a good option at the time. Yeah. And I'm not doing the mathematical stuff that I would do to put this trade on. So this might not be. Just put something on like that just to kind of, this might not be exactly mathematically correct, but, again, it would look something like this. So if we dropped all the way down, let's just commit this as a test. Test Google. Drop. So this is before all the craziness happened. You're going from a very nice normal market to a crazy market, right? So that's the worst. That's usually the worst, when something changes over, because once you're in that market and you have the higher volatility, you're going to be able to get out further. But when you go from a lower volatility to a higher volatility, or bigger moves, is that first shock. So this would probably be the best to sense what that would feel like. So if I look at my T lines, I got some pretty decent move here. Let's just take a look what happens. Of course, this is theoretical, so I don't know if I would have been able to get those prices. So the end of the day, usually very end of day pricing is not very reliable, but whoops, there's 1 o'clock. Yeah. See, I'm not so sure because this is not as reliable here, but let's go Monday morning. Okay, so we do have that big drop down on Monday morning, and we're down $364. Okay, 31%, but $360 is not probably going to blow up your account. Yeah, you're going to have some slippage. So that just kind of gives you an idea. It's not like you're going straight to the maximum loss, which in this case was $1,100. So not great, but you're not, dead in the water. And you can make that up probably in a couple of trades with Google or one.
Yeah.
Does that make sense? So, yeah.
Roger asked, will there be at least one SPX trade? I know a lot of people like the indexes because Section 1256 at the IRS gives you a little tax break.
Yeah. Right now, the SPX has some really good volatility. So that's one of the ones that I've been doing once a week. And usually once a week, unless there's some weird thing that it doesn't look good. But the examples that I show, I think there's one on every week except for maybe 1 week. I didn't find a good setup. And once volatility kind of comes out of the SPX, you can always do the NDX or the Russell 2000, just as long as the math works out. So I'm always going to try to pick at least one index and try to pick one at least once per week. And right now the SPX is the top candidate for that.
Steve just asked tax breaks. Yeah, there's a IRS code, Section 1256. Index options are 60% of the gains treated as long term, even if you hold it a minute. So just look up IRS Section 1256.
Yeah, it's a great tip. Let's see, some of those are already answered.
Serge was asking, are you going to teach the mechanics of the trade, or is it going to be more like a black box?
I'm going to teach, the mechanics of the trade, but I'm going to do all the work in putting it together, so I guess it's kind of, half and half. I mean, I could teach what I'm looking for in that particular moment in time, but like I said, every time I look for and try to scan for something and look for the setup, it might change a little bit based on that particular moment in time. So I'm going to try to give as much information so that anybody who wants to follow along with a trade alert service will be able to understand what I'm sending, why I'm sending it to them. And then, you should be able to, make some trades on your own if you want to. But the service is basically there so that all of that homework and all of the picking of the strikes and the candidates and all that kind of stuff and is done for you, basically. Let me go back here. Okay, I already answered that one. Okay, so here I'm starting off with some questions that I haven't answered yet. How are you finding the fills on SPX? It looks like these call verticals with a debit spread in the money. Are you having to pay up for the mid? Sometimes you can get the mid. Obviously, when I like to go in is I try to go in, they kind of bounce around a little bit. So I try to go in as low as possible, and then I'll kind of give from there. Usually, and Dan mentioned this as well with the SPX, that the getting fills, 5-10% or 5 or 10 cents off the mid, like high, paying a little bit more for that. Sometimes he pays even 15 or 20% or 20 cents more than the mid price for the SPX. I put one on last week, and it was 10 cents over the mid price. And sometimes, like I put on a trade a few weeks ago or a couple weeks ago in NVIDIA, and that one triggered on the mid. I put one on yesterday, and I had to pay an extra 10 cents. So, they kind of bounce around a little bit. So I always try to get a better price and be patient. And then after a while, I'll either, change my price and give them a little bit more, or if the market moves a little too much, I might have to change my strikes. What's your theta at start of trade on example 5,000? It's different, but it's always higher than the Vega for sure. And it depends on how many contracts you do. So for instance, on this particular one, this was a SPX trade. The theta on the start was $54. And I don't know how many days to expiration. This one was probably about 10 or 11 days to expiration. And this goes up very, very quickly. So one day in the trade, it's already up to 77. Let's see here, that's one day in the trade. But a few more days in the trade, it's up 94. So it goes up exponentially pretty quick. Was the 10.8% an actual trade or historical simulation? That was an actual trade. I believe that was one on the SPX, I think. I'm not sure. There was a couple of them on the SPX where I made more than 10%. I think the ones that I'm showing, though, is just before I close it, so you have to add in any commissions. And I'm using Tasty Trade or whatever. And they don't charge you commissions on the closing, but SPX is higher commissions now because the fees are higher. So it used to be like $1 a contract on the opening and closing, and now it's $1 a contract on the opening plus fees, and then 0 on the closing, but you have the fees too. So, but it's not that much. I mean, I'm talking, you're talking about maybe doing, I always like to have at least a two lot. 2 contracts at least for everything so that I can have some room to do some adjustments. What do you mean by class? Is this for a boxcar? This is for, I meant the trade alert service is going to have its own account that you can follow along. So I just call it the class account, the alert service account. The service is going to have an account that you can follow along with. Steve. Marcos, on a separate note, I'm interested in your the time zone trade strategy. Would I get a discount on it? Actually, that's from a different company. That's from SMB options or SMB.u or SMBU.com. I always forget what it is. Yeah, that's at SMBU. So that's actually, they're a completely separate company than Aramir. So if you want to get a discount from that, you have to contact Seth Freudberger over there at SMB. And he's, I'm sure he's good about working with people on that kind of stuff. So tell him I told you to call him. Link, okay, that was me sending a link. Will there be at least one SPX trade per week? That's what I'm going to attempt to do, is one at least, as long as it's viable, there'll be one a week. And if it's not in the SPX, I look at other indices as well. Let's see, we talked about that already. Good question. Yeah, I definitely want to give a good education. That's another reason why I'm going to have, I don't want it to just be a total black box. It's another reason why I'm going to have weekly recaps, so that every week, I'm going through like, well, what happened here? Why did I do this? It's not just about putting the trade on. It's also about, well, why did I choose that adjustment over this adjustment? Or why didn't I do an adjustment? So that's what those weekly recaps will kind of cover as well. So not just the kickoff meeting where you guys can ask questions and I'm going over everything and showing you how it's done and what I'm doing, but also those weekly recaps, which are also recorded, so you can watch those as well. So you have a nice continued education. So that's what the trade alert services, at least at Aramir, are all about. It's not just about getting necessarily just a black box, which is probably more suitable for something like if you're just buying or selling a stock or buying or selling a single option or something like that. But actually getting the education behind the service, the trade alerts as well. So the trade alerts are to follow along. You don't have to do the homework, all that kind of stuff. Follow along. And you can see how it performs, because that's why there's that class, or what I call it, class or service account. You can kind of follow along with that. And all the videos and stuff are the education, so you can kind of learn as you go along. You're kind of learning over my shoulder, so to speak. Okay, when the classes are going to start? I figured May 15th is what, a Saturday, Tom, or a Friday? Is that when the sale ends?
Let me look at my calendar. That's a Friday.
Friday. So I think that it should start May 18th, the following Monday. So after the sale, right?
Yeah.
Yeah, that gives people plenty of time to sign up. And because I don't want you guys to, if you sign up, I want you to get to do the kickoff meeting. I want you to do it live, right? So that gives you plenty of time to sign up. And the live class will start that following Monday after the sale ends. Of course, it'll be recorded for anybody who misses that, though.
Do you always put the trades on a specific day of the week, depending if it's a stock or index?
I sometimes I like Mondays are a little tricky, because sometimes like for SPX I don't really want to do that on a Monday. But I look throughout the week, so I might have something. I'm going to try to make it as easy as possible for everyone, because so that you expect stuff like, but Tuesdays, Wednesdays, Thursdays, Fridays, I mean, all of those days could be good days to enter a trade, even Mondays. So, but I think Mondays are probably the least likely day that I would send out alerts for new trades, but I want to have multiple ones per week. And sometimes there's going to be one on a Tuesday, and there might be two on Thursday and one on Friday, something like that. So as the service goes along, I'm, obviously I'm open to suggestions and what people prefer and that kind of thing, but it could be any day of the week, but most likely not on Monday.
Here's one. Marcos just signed up. Thanks, Marcos.
Oh, hey, thanks,
And
Marco. Looking forward
yeah,
to seeing that.
I'll adjust the billing date. So the second billing will be on the 18th of June.
Okay, great. So people don't, lose a few days. That'd be perfect. And then this particular recording that we're doing today, you can add that to the sales page. So anybody who wants to rewatch it, they have a place to watch it again there
Right.
until everything's set up. In terms of AIC language, what is a typical tranche for this strategy? Well, we like to, you can enter it as two separate verticals, but it's easy sometimes to just enter it as we're going to just kind of enter them as a custom order. Most of the time they're custom orders. Sometimes they're equal number of contracts, so it would be considered a condor. But like it's a four-legged animal, it could be entered as one trade. But there's the only thing I could say about tranche, it's not like the AIC or the weird or is set up where you have a certain number of credit spreads and a certain number of put debit spreads and a certain number of call credit spreads, that kind of thing. It's not really set up that way. Every trade is different. So for instance, I might have one in the SPX where all of the contracts are the same. I only, it's a one-to-one. I've got one vertical where I'm trading one contract and another vertical selling one contract. And then I want to always have at least two. So it would just be like selling two condors. But there's other times where it's uneven. So I might have two verticals against three verticals, or two verticals against four verticals, or two vertical or three verticals against six verticals, or sometimes two against five. So it really depends on the math. And that's, again, one of the things about the service that I will be doing that work for you, even though I'll be teaching you about, trades that you can do on your own. I'm also going to be doing all that work for you. So sometimes I'll have the same stock or the same underlying where it's a one-to-one relationship one week and the next week it's not a one-to-one. So it's a custom trade, but there are all going to be a trade that you can put in as a single trade, four legs. Pretty much every brokerage firm, and I know most of you guys are Thinkorswim, but every brokerage firm allows you to do a four-legged trade. So there's not really any kind of tranche other than it's just they're all going to be stocks I'm going to keep under, or do my best to keep them under $2,500 for a Reg T margin on any kind of stock trade that we do for the Boxcar, and for the SPX I'll keep it under $5,000 margin. Let's see. What time will be alert? Sometimes they're in the morning and sometimes they're in the afternoon. So it really depends. But, if you can't really do anything about it until you can get to your computer, it's okay. It's not like they're really difficult. I mean, if there was something where we had a situation where, we had like we showed with that Google, like it happened to crash or whatever, and you just wanted to get out, almost all brokerage firms have phone apps, and you can just put in a closing order to close it out if it was something like that. It was like an emergency. But everything that we're going to be doing is very simple spread trades. So, and not very much adjustments. Most of those examples I showed you were no adjustments or maybe one adjustment. So pretty simple stuff. So you don't have to necessarily act on it as soon as the alert comes out if you can't, like if you have a full-time job or something like that. What percentage of trade would be fees on average? Oh, like commission fees. Not much. So for instance, let's say, here's one. So this was, here, let's go, I don't know. I'll go to the beginning here, I think. So this one, $3,400 maybe is the max risk on the downside. And we're up 10%, 372. And this one was probably a, probably no more than 2 contracts to maybe 3 contracts. So let's say 2, 4. So probably like a total of 10 contracts going in and 10 contracts going out. So, maybe $20 or something out of the 372 at the most, I guess, so it's pretty small. I like using Tastyworks, but they're like, they don't have a closing trade. They have fees, but they don't have a closing trade. But I think Thinkorswim is only charging 65 cents now. So it's all about the same. So it shouldn't be that much as far as percentage wise, like maybe $20 or something in total commissions. I should have actually grabbed that. That's something, ask me that again if you sign up and we're on the kickoff meeting, and I'll look it up. When will trade alert service start from? Okay, we said the 18th, which is a Monday, May 18th. So that's in like, less than 2 weeks, I think. You can use Thinkorswim, Taste, whatever brokerage firm you want. I think I'm going to be sending out alerts that look like Thinkorswim alerts. I'll talk to Tom a little bit about that, because that way you can just cut and paste them directly into your Thinkorswim platform if you have them, and I'll show you how to read those if you don't have Thinkorswim. Let's see. On average, from your past experience, is it safe to say that we can earn 3,000 to 4,000 on planned capital? Did I really read that right? To be honest with you, I was kind of shocked, but yeah, you read that right. I was actually, from a $12,000 account, I was able to bring in $4,200. I did a lot of trades though. And actually there was a couple of them I did, in the same week. So I don't know if I'm going to be doing quite as many trades, but it's possible. I was able to do it over the last several weeks. Dan, I think, is doing more because he's staying in longer, but I just don't like the risk. So, and I don't want to stay in. I don't want to have too many adjustments going out. Sometimes it's hard for people to follow multiple trades with multiple adjustments. So I think that's better to kind of teach you guys. If you want to stay in longer, you can do this kind of thing. I'm going to get out earlier on the class or service trades because I don't want to be dealing with a lot of extra adjustments that might be needed. But it's certainly definitely possible, believe it or not. So, I like to be conservative. So, I mean, I've got my own personal account that I'm trading this as well. So I'm going to be, and I'm not going to be front running you guys. I'm going to be putting on trades after I send out any alerts or anything like that from my own account. But I'm just going to be, very conservative and try to bring in, $400 or $500 a week on my own account, which is fine with me. If I can do that without spending a lot of time, that's pretty cool. So just doing a couple trades a week or so, 2 or 3. Let's see, risk of assignment with stock in the strategy. Again, you don't want to go to expiration day. It's pretty low risk, even if you're in the money. But I'll, can give some tips on that when we're, if we're looking at a particular trade that might be at risk. But it's pretty low risk. And I again, are going to be more conservative with these class trades where I'm just going to be taking them off. Usually once we get into like a day or 2 of that final week of expiration. Usually the assignment comes in the day of expiration or sometimes the day before. I'm not going to be taking them in that long. And if that was the case, I would certainly take off the in the money, anything that, if there was a spread that was in the money, I would take it off. I just signed up, so 50% discount started from today. So you get 50% off for the first month, and then after that, it's the $99 a month, but you'll never be charged more than $99 a month as long as you stay subscribed. Shouldn't that start on the 15th? It starts, yeah, you're not going to get, I don't know, Tom, how the billing works. I think you don't get billed until the day of the class starts or something like that. Is that how it works?
Yeah, anybody who signs up, I'm pausing the billing until the class actually starts, and then I'll turn it back on. So right now it'll be a month after that. So June 18th will be the next bill date.
This is a great question. Do you adjust often using conditional orders? Actually, I like looking at alerts. The prices can kind of bounce around sometimes for these, so I don't feel comfortable putting in a conditional order. Dan mentioned the same thing as for him. You might want to, maybe on a downside, like a big, huge move down, like if the underlying gets to a certain point, you might feel comfortable putting in a good till cancel order. But I usually use alerts, which sometimes get triggered before they're supposed to as well, but usually I just use alerts as opposed to conditional orders for as far as for any, losses or adjustments or anything like that. But as far as profits are concerned, then yeah, absolutely. Put in a conditional good till cancel order for profits. Like if you want to try to make 7 or 10% and okay, in order to do that, I need to close this whole thing out at, $5 or something like that, then that's actually something that's a good idea. Just put it in. You might get triggered. It might not, but it's already in there. So if you're busy, you might be able to get a nice surprise and have a nice big profit while you weren't looking. Do you recommend using tasty instead of TOS? No, it's not going to make it easier. TOS, obviously most people, and we can probably do some kind of a, poll to see how many people are using TOS that are in the service. Since most people use TOS, I'll just most likely use their platform or their structure for building the trades. But it just depends. If it turns out that most people aren't using TOS, I might change that. So we can do a, but they're easy. I'll show you guys how to read them. They're very simple to read anyway, no matter what service you're using, and it's pretty easy to enter them in any brokerage firm. It's just like I said, it's just a very simple four-legged trade, or you can put it on as 2 verticals if you like as well. So let's see, not like Forex, so that's about 4% for fees. I'm not really quite sure. The fees, they're not that, on the stocks, the fees are really small, but I noticed on the SPX, they're kind of large. So SPX is ending up to be like about $2 a contract now. So I'm kind of glad that I'm not paying that closing contract commission on Tasty because of all the fees for the SPX. But for stocks, it's really small. So for stocks, so you're talking like, whatever, 20 cents or something for the extra fees and on top of the commissions. Yes, the price there is per month. On average, okay, we already talked about that. Are you still trading the time zone and weirdo? No, this hasn't been. This is a great addition. I mean, it just doesn't take up a lot of margins. So yeah, I still trade the time zone and the weirdo for sure. Best for environment we are in now. It's great for the SPX. It's great for the environment we're in now because the SPX has higher volatility, so it actually makes for good candidate right now, which might not be if it gets down to like 12 volatility in the future. But there's always going to be stocks that have enough. There's always going to be good candidates in stocks that have enough volatility to find a good candidate, even in a environments that are more calm. There's always going to be something going on with some sector or some stocks that are going to make those stocks a good candidate. And in addition, there's other indices as well, like the NDX, which is probably always going to be a good candidate because it tends to move around quite a bit. Could you please look into Tradier brokerage service, as they have $30 monthly subscription on stocks and options? That's pretty cool. I've never really looked into them. Tom, have you?
Yeah, I talked to their CEO a year or so ago. They have a flat commission rate, which is attractive, but I heard the platform's not the easiest or most intuitive to use. So there's pros and cons with it.
Right. And then Michael's asking, do you use one software? Is it necessary? It's not necessary to use one software. Dan doesn't use anything. Dan uses a spreadsheet, which I think he said it will make available for people that don't want to use anything other than a spreadsheet. We can put that in the documents download section of the class page so that you guys have access to that if you like to use spreadsheets. And you can also use Thinkorswim to simulate trades. It's a little cumbersome sometimes because you have to put in, well, it's not that cumbersome, but it's a little different. One, in option view, keep track of previous gains and losses on previous, like if you make an adjustment, that kind of thing, and you close out a leg of the trade or move it around. It keeps track of that, whereas Thinkorswim only keeps track of open positions, but you can use the simulated trades in the analysis tab to simulate those, any kind of closing legs or things like that to show what the previous gain or loss is, so that way you can make it look like one or option view. not like alerts for Forex in the middle of the night. No, it's not going to be like that. And I'm not going to be sending them out at like, first thing in the morning, like, well, I'm in California, so 6:30 in the morning. Nope, I'm not going to be doing that either. So, which
Yeah,
do you like better?
that's a challenge with my trade alert with Expert Signal trading currency futures. And
Yeah, I bet.
I had a trade at 2:30 in the morning yesterday. So
Oh, ouch. Yeah, no, not for me. But you're like a night owl, or I don't even know if you're. What would you call somebody that stays up 24/7?
yeah, insomniac. Yeah.
There you go. So what do you like better, Option View or Option Net Explorer, or some? I don't know of anything better. Those are the two top ones. Option Net Explorer is definitely less expensive. I think it's like about half the price of Option View. It's just personal preference. I like that Option Net Explorer gives me 5-minute increments of for when I do back testing, when I'm, studying a new strategy or stuff like that. And, I like it. It's nice. There's some things about Option View that I wish Option Net Explorer had, like overlaying, different trades on top of each other. But it's definitely less expensive. Lately, I've noticed there's been a couple of bugs in Option Net Explorer that have been driving me crazy, but, I have to click a button to, kind of snap out of that mode. But it's a pretty good. They're both great programs. So it's personal preference, and like I said, Option Explorer is definitely cheaper. So, and I think they have special. And I know Tom, you probably have some kind of link on Aramir to
Yeah, I
have
think
special support, right?
there's a 15% discount for O&E for Aramir members,
Okay, cool.
which makes it
So
even cheaper.
yeah, there you go. By the way, we can put trade directly from Option Explorer to Tradier. They have integrated. You can actually put in a trade almost direct. Well, you can kind of put one in directly for IB, although sometimes it works and sometimes it doesn't. Personal experience. But you can kind of do it from Thinkorswim as well, because in Option Net Explorer, let me see if I can go there. Let's say I've got this on Thinkorswim. So let's say I wanted to close this. I don't, obviously. Wait a minute. This is not live. Let's go live. And let's just, well, let's pick something. Let's pick something. I don't know. Do I have anything SPX? What do we got here? All right. Here we go. So let's say I just put it on. Let's say I wanted to close it out, and I click commit or something like that, right? Why is it not showing up? Oh, I think it's only for live. Okay, let me go live. I think I can only do this live. Okay, so let's say I'm live and I put on a new position or something. Whatever. I hit commit. It's got this little Thinkorswim button down here. You can actually, if you click this button, it'll send the trade to one, and it'll copy the trade to the clipboard. You could also click send without save, so it doesn't save it in one, but it copies it to the clipboard. Then you can go to Thinkorswim, and you can paste it. Whoops, there's already something there. Let me delete that. You could paste it right into the order entry screen of Thinkorswim. So it doesn't go through automatically, but it's close. And then you can, maybe change your limit price or do whatever you want and confirm and send. So that's kind of a nice little trick there, but it has to be with, in one, it has to be live. You can't go, obviously be back testing and doing it because, you're trading live, right? So, all right, so let me see if there's any other questions, and I think that pretty much does it for, oops, where are we here?
Yeah, we're a little bit over, but we had some questions, so that was good.
Okay, good. Okay, I think we're done. I don't see any more questions. So, hey, thanks everybody for joining. I hope you guys, sign up or got something from this anyway. It's a great trade. Dan and I both really love it, and look forward to getting started and sharing this with you guys.
Oh, and I guess if they have questions about it before they sign up, they can email you, right? Like amy@aramir.com.
Yeah, I don't know where you've got amy@aramir.com going, but if you have it coming to one of my accounts, then
I think it does. I'll test it or verify with you that's the right alias, but that should get to Amy,
yeah,
that email address.
cool. All right,
All
thanks.
right. Thanks everyone for sticking with us and enduring all the questions. So
Yeah,
looking forward to it. I know Dan loves this trade, and everybody was excited when they saw it a month or two ago in the Trading Group 1, and happy to have it morphing into a service. And somebody I remember asked why a service. There are rules, but every trader is different. And Amy, you're a great trader. I've known you a long time, and a lot of Dan's systems always have a lot of trader's choice in it. So it's nice to see how an experienced trader trades it, besides just the rules. So
right,
anybody
right.
can put on a trade, but how it ends up is different from trader to trader.
Right. And I like the workshops and things like that, but um, I mean, and we can do something like that as well, but I think that this is perfect for a trade alert service. And, I'll definitely be giving, a lot of detail about what I'm doing so you guys can understand that as well. But if it comes down to something where we want to do stuff like live together, or, hey, let's look for trades together, and get into even more details about stuff, then, doing like a live workshop during uh, um, market hours is always a possibility if people really want to do that kind of stuff too, but um, this is, I think it'll be perfect for, like Tom said, trading over my shoulder, so to speak. So,
Right.
great.
All right. Thanks everyone. Thanks,
Thanks,
Amy.
Tom.